So, one country lost its perfect credit rating this year. The other one didn't move an inch. Moody's stripped the United States of its final top-tier AAA rating, downgrading American debt to AAA1, while Canada, carrying its own large deficits, its own rising debt load, held its full AAA rating steady across every major agency. Wall Street noticed within hours of the American downgrade. Bond yields moved. Analysts started drawing comparison charts nobody in Washington wanted to see. And according to people who track sovereign credit markets closely, the gap between these two trajectories, one nation's rating cracking for the first time in generations, the other nation's holding firm through its own fiscal pressure, tells a story about spending discipline that has almost nothing to do with which economy is actually larger. Warren Buffett, who has spent decades reading balance sheets the way other people read headlines, offered a blunt assessment of what a credit downgrade like this actually signals. A downgrade isn't an opinion, Warren Buffett said. It's a verdict on decisions that were already made, years before the letter grade caught up to them. When you hear exactly why Moody's made this call, what Canada did differently to keep its own rating intact under similar pressure, and what bond markets are already pricing in as a result, you'll understand why this quiet divergence between two neighboring economies is being watched more closely by institutional investors than almost anything else in North American finance right now. Hit subscribe because credit downgrades don't resolve quickly, and the consequences of this one are still working their way through the bond market. Let me give you the full context. Because a sovereign credit downgrade doesn't happen over a single bad quarter, it happens over years of accumulated fiscal pressure that rating agencies watch and warn about long before they actually act. The United States had already lost its perfect rating from two of the three major agencies years earlier. First from Standard & Poor's back in 2011 following a bruising debt ceiling standoff, then from Fitch in 2023 amid concerns about repeated fiscal brinkmanship and a rising federal debt trajectory. Moody's was the last of the three major agencies still holding the country at the top rating, and it had maintained that position even as it flagged year after year a set of underlying concerns, a federal deficit that kept growing regardless of which party controlled Congress, an interest bill on existing debt that was consuming a larger share of federal spending every year, and a political environment in Washington that repeatedly demonstrated an inability to agree on any credible long-term path back toward fiscal balance. That warning finally became an action this year. Moody's downgrade of U.S. debt from AA to AA1, announced in May, closed the loop, meaning for the first time in the agency's history covering modern America, all three major rating agencies now rate U.S. sovereign debt below the top tier. Most Americans don't realize how significant that milestone actually is, because a one-notch downgrade sounds, on its face, like a minor technical adjustment. It is not treated that way inside institutional bond markets, where AAA-rated debt occupies a specific privilege category, the safest possible harbor for the most risk-averse capital in the world, pension funds, insurance reserves, foreign central bank holdings. Falling out of that category, even by one notch, changes how some of the largest, most conservative pools of capital on earth are contractually and internally permitted to hold U.S. debt at all. Contrast that trajectory against what was happening in Canada during roughly the same window, because the comparison is the whole story. Canada entered this period from what credit analysts describe as a fundamentally stronger starting position. A lower overall debt to GDP ratio than most G7 peers when measured on a net basis, even as its gross debt figures, which don't subtract financial assets, look less favorable in isolation. Prime Minister Mark Carney's government, facing its own pressure to increase spending, particularly on national defense commitments that have become harder to avoid amid rising geopolitical tension, planned historic levels of government borrowing, gross issuance for the 2025 to 2026 fiscal year exceeding even the peak borrowing levels seen during the pandemic. On paper, that sounds like exactly the kind of fiscal trajectory that invites a downgrade. Rating agencies looked at it and so far concluded otherwise. Most Americans don't realize how much that outcome depended on the specific quality of Canada's starting fiscal position rather than the size of its new spending. Credit analysts who cover Canadian sovereign debt have been explicit about this distinction. Canada began this borrowing surge from what one Desjardins economist described as a very strong fiscal position relative to its developed economy peers, meaning the new debt, however large in absolute terms, was being added to a balance sheet that had room to absorb it without immediately threatening the country's overall creditworthiness. The United States, by contrast, had spent years running structural deficits from an already weaker starting position, adding new debt on top of a base that rating agencies had been flagging as increasingly precarious for the better part of a decade. The tipping point for the American downgrade, according to people who track rating agency methodology closely, wasn't any single piece of legislation or any single deficit figure. It was the accumulated pattern, year after year, of repeated debt ceiling standoffs that rattled markets regardless of how each one eventually resolved, of fiscal projections that consistently assumed spending discipline that never actually materialized in subsequent budgets, of an interest expense on the national debt that had grown, by the time of the downgrade, into one of the largest line items in the entire federal budget, competing directly with defense spending and major entitlement programs for a shrinking share of fiscal room. Something had to give in the agency's own methodology, and Moody's, the last holdout among the big three, finally concluded that the accumulated evidence no longer supported a top-tier rating. Let me walk you through what actually happens inside a credit rating committee when a call like this gets made, because it's a far less dramatic process than the market reaction to it suggests. Picture a Moody's Sovereign Ratings Committee meeting. Analysts who have spent months building fiscal models projecting the federal government's debt trajectory under a range of policy assumptions, spreadsheets tracking interest expense as a share of revenue, comparison tables benchmarking the United States against every other AAA and near AAA sovereign in the world. According to people familiar with how these committees typically operate, the debate on a downgrade of this magnitude isn't usually about whether the underlying fiscal trend is negative. That conclusion tends to be uncontroversial among the analysts who track it closely. The debate is almost always about timing, about whether the deterioration has crossed a threshold significant enough to justify the market disruption a downgrade of the world's most important sovereign borrower inevitably causes. The moment the decision becomes final and the report goes out is almost anticlimactic by design. There's no press conference, no dramatic unveiling. A report is published, a rating action is logged in the agency's public database, and within minutes, trading desks across the world's largest banks are running the same query, checking exactly which categories of institutional mandates require automatic rebalancing away from any debt that falls below the top tier. That mechanical, almost bureaucratic process, rules-based selling triggered automatically by a rating change rather than any individual trader's judgment about the underlying economics, is what makes rating downgrades move markets as fast and as broadly as they do, regardless of how much advance warning the market had that the downgrade was coming. There's a quieter irony sitting inside the timing of this specific downgrade that market historians have already begun pointing out. The report was published on a Friday afternoon, a scheduling choice ratings agencies frequently favor for consequential actions, allowing markets a weekend to digest the news before full trading volume resumes. According to people who track how these announcements are typically handled, that timing wasn't accidental. It's a pattern institutional analysts have observed repeatedly across major downgrades of large, systemically important borrowers. A small, deliberate cushion built into the release schedule specifically because the agencies themselves understand how disruptive their own conclusions can be to markets that depend on stability. The aftermath moved through bond markets within the same trading session. Treasury yields ticked upward as some of the automatic institutional selling worked through the system, a signal that borrowing costs for the federal government itself were about to rise. A particularly uncomfortable feedback loop, given that rising interest costs were part of what triggered the downgrade in the first place. Financial commentators spent the following days debating how much the downgrade actually mattered, given that Treasury debt remains, whatever its formal rating, the most liquid and widely held sovereign asset in the world. Administration officials, in public statements, downplayed the significance of the action, arguing that rating agency models failed to adequately capture the underlying strength and growth potential of the American economy. Independent economists, for the most part, were less dismissive, noting that whatever the agency's models might miss, the underlying trend they were responding to rising debt. Rising interest costs and a demonstrated political inability to address either was not in serious dispute. Canadian officials, watching the reaction from the other side of the border, were notably restrained in their own public commentary, according to people who track cross-border financial diplomacy. There was no triumphant statement from Ottawa, no comparison drawn publicly between the two countries' fiscal trajectories. Finance officials in Canada, according to people familiar with internal messaging guidance issued in the days after the American downgrade, were specifically instructed to avoid any commentary that could be read as gloating, understanding that an unnecessarily pointed remark risked drawing exactly the kind of attention from Washington that nobody in Ottawa wanted, while quiet capital reallocation was already doing the talking on its own. Behind the public statements, according to people who track institutional bond allocation, the more consequential shift wasn't the immediate yield move, but the longer-term portfolio rebalancing, the downgrades like this quietly trigger inside the world's largest and most conservative pools of capital. Some sovereign wealth funds, pension systems, and insurance reserves operate under formal mandates requiring a minimum share of holdings in top-rated sovereign debt. As the United States joined the ranks of AA-rated sovereigns, some of that capital, over time, began quietly reallocating toward the smaller pool of countries that still carry a clean AAA rating across all three major agencies, a list that includes Canada, Germany, Switzerland, Australia, and a handful of other economies with smaller total debt markets than the United States, meaning even a modest reallocation toward that shrinking pool of top-rated alternatives represents an outsized flow into markets a fraction of the size of the U.S. Treasury market. Warren Buffett's fuller analysis of the moment reframes it away from the immediate market mechanics and toward what he considers the more important long-term signal. In his experience, Buffett has said, credit ratings function less like predictions and more like report cards, graded on a lag, reflecting behavior that has already occurred rather than forecasting behavior that hasn't happened yet. Buffett's economic translation of the divergence between these two countries is direct. The United States didn't lose its top rating because of a single bad year. It lost it because, for the better part of 2 decades, through administrations of both parties, the country consistently spent more than it collected, and consistently deferred the harder decisions about entitlement spending and revenue that would have been required to reverse that trend, while Canada, despite its own large and growing deficits, entered this period of increased spending from a balance sheet that had actually been managed with enough discipline in prior years to absorb the new borrowing without immediately threatening its top rating. The historical parallel Buffett has drawn on goes back to his own decades of evaluating the balance sheets of companies before deciding whether to invest in them. He has described watching businesses maintain an outward appearance of strength for years after their underlying financial discipline had already eroded, right up until a specific external shock, a recession, a credit crunch, a change in market conditions, forced a reckoning that had actually been building the entire time. The universal principle he extracts from that pattern is one he has repeated often. A balance sheet doesn't fail on the day the rating agency downgrades it. It fails gradually, in the accumulated decisions that precede the downgrade by years. And the rating action itself is simply the moment the outside world's assessment finally catches up to a reality that had already been true for a long time. His verdict line on this specific divergence has already been repeated widely across financial commentary. Canada didn't do anything remarkable to keep its rating, Buffett has said. It just kept doing consistently the unremarkable thing the United States stopped doing years ago. Now let's talk about where the consequences of this actually travel, because a sovereign credit downgrade of this significance rarely stays contained to bond trading desks. Economically, the most direct exposure runs straight through the federal government's own borrowing costs. Every percentage point of additional yield the market demands on newly issued Treasury debt compounds across trillions of dollars in outstanding and future borrowing, meaning even a modest, sustained increase in borrowing costs translates into tens of billions of dollars in additional annual interest expense, competing directly against defense spending, infrastructure investment, and entitlement programs for a federal budget that was already strained before the downgrade. That dynamic creates a difficult feedback loop. because rising interest costs were themselves one of the factors cited in the downgrade decision, meaning the downgrade risks making the underlying problem it identified somewhat worse. There is a competitive dimension to this that matters well beyond government borrowing costs. As global capital gradually reallocates toward the shrinking pool of countries retaining a clean top-tier rating, Canada finds itself, almost by default, among a smaller and more exclusive club of sovereign borrowers able to offer institutional investors the very safest category of debt. That positioning carries real economic benefits, potentially lower borrowing costs for the Canadian government itself, and increased attractiveness as a destination for the kind of conservative, long-duration capital that insurance companies and pension funds are specifically mandated to seek out. None of this happened because Canada did anything dramatic. It happened largely by contrast, simply by continuing to occupy a rating tier the United States had, for the first time in the modern era, fallen out of entirely. The irreversibility of a sovereign downgrade deserves particular emphasis, because unlike a single bad earnings report, a rating action of this significance tends to be sticky. Rating agencies are historically cautious about upgrading a sovereign back to its previous tier, generally requiring years of demonstrated fiscal discipline, sustained deficit reduction, and credible long-term budget projections before considering a reversal. That means the practical consequences of this downgrade, marginally higher borrowing costs, a smaller pool of automatically eligible institutional buyers, a permanently altered comparison point against peer economies like Canada, are likely to persist for years regardless of what happens in any single subsequent budget cycle. There is a generational dimension to this story that Americans nearing or in retirement will feel more directly than most, because rising Treasury yields, while sometimes framed purely as a government financing story, ripple straight into the cost of everything, from mortgage rates to auto loans to the yield calculations behind fixed income retirement portfolios. For a retiree holding a portfolio weighted toward what used to be considered the single safest asset class on the planet, a downgrade doesn't change the government's ability to make interest payments in any immediate sense, but it does change the calculus that professional money managers use when deciding how much of that portfolio should sit in Treasury debt versus diversified alternatives. And that kind of institutional recalibration, even when gradual, eventually shows up in the products and advice ordinary savers receive from their own financial advisors. So where does this leave things? Three figures anchor this story and are worth repeating because they will keep surfacing in financial coverage for years. The one-notch downgrade that took the United States from AA to AA1, the final agency to make that call after two others had already done so years earlier. The $612 billion borrowing plan Canada pursued in the same fiscal year, a historic sum that nonetheless failed to dislodge its own top rating. And the roughly 15-year stretch from the first American downgrade in 2011 to this most recent one, over which all three major agencies gradually converged on the same conclusion about the trajectory of U.S. fiscal policy. Those three numbers, the downgrade itself, the scale of Canada's own borrowing, and the length of the warning period that preceded the American downgrade, tell the entire story of how two neighboring economies arrived at such different outcomes despite both taking on enormous new debt in the same stretch of years. The philosophical verdict here isn't really about credit ratings, or even about which country borrowed more in a given year. It's about what happens to any balance sheet, a household's, a company's, a nation's, when spending decisions consistently outrun the discipline required to sustain them, and how long the consequences of that gap can stay invisible before an outside evaluator finally puts a number on it. Canada's fiscal position isn't without its own real risks, and analysts who cover it are careful to note that its own rating could face pressure if its debt trajectory continues without a credible path back toward balance. But for now, the gap between these two neighboring economies is real. It is measurable in yield spreads and rating letters, and it is the kind of gap that tends to widen quietly for years before most people notice it has become permanent. What happens in the coming budget cycles in Washington and in Ottawa will determine whether this divergence closes or deepens, and bond markets, unlike political rhetoric, are already pricing in an answer.